Yesterday, we came across this tweet, which has fascinated us, as this guy here, Carlos, claims that he's down $430,000 in a portfolio, a hodgepodge, really, of spider puts. Now, some of the comments say that he's long $16 million of equity, and it's not entirely clear. But the point is that this guy says he's just chilling with this $500,000 in unrealized losses. The fact that he says he feels uncomfortable with this is a little bit insightful to maybe doesn't have a longer portfolio, because if you're long $16 million of equities and you're just taking a 2% loss with these spider puts, then should you really be uncomfortable? I don't know. The point here is let's check out what this SPY put portfolio looks like and kind of what has to happen just for this specific portfolio to break even. So what I did here in Thinkorswim is I just loaded these positions up. You can see they're all down here towards the bottom. And what you'll notice is the P&L from this position. All else equal, this purple line tells us that in order for this portfolio to break even, all these spider positions to break even, the market has to go, the spiders that is, have to go under 400. Now, today is FOMC day. We have a big options expiration on Friday. And so we are expecting some volatility and the market to move down. But this is a major move. This is a 10 to 15% move, right, to get this portfolio to break even. And the problem with this is that the longer time marches on, the lower and lower you need the market to go for these puts to break even. This is the factor of time decay. And you can see here, Thinkorswim tells us that it's roughly $1,600, $1,700 of daily theta decay in these put positions. And so again, what happens, and you can see in this blue line, as we move to August expiration, which is when the first of these positions expires, you got to get the market to go down to 390. So that's a pretty big punch lower. Now, the saving grace of this could be if we get a major vol pop. Now, obviously, if the market goes down, we would expect implied volatility to go up, right? VIX tends to go up when the market goes up. And so what we could do here is kind of add what Thinkorswim calls a vol step here, and they just shock implied volatility up a little bit. And so what is interesting about this is that if you shock implied volatility down, and if we change this date, let's just say to June 30th, what you can see is that if you get a decent pop in implied volatility here, you get a break even that starts to happen a little bit closer to that 410-ish area, right? Certainly above 400 if vol really moves, but you can see this vol spike can actually start to materialize and help the portfolio to recover. And most of that is sourced from this long vega position, right? When you're long puts and then implied volatility pops, well, that's vega kicking in and hopefully helping you to recover. Now, from our lens, it's hard for the market to go much lower than this kind of 420 area. And we're going to show you that in our dashboard here. Now, this June options expiration is massive and it's call heavy. And in our subscriber notes, we said, hey, it could cause some weakness. The Fed could maybe trigger a little bit of consolidation here. But the problem is there is a ton of gamma at 4,300. Now, a lot of this is going to expire and change, but you have a lot of positions that will remain at both 4,200 and then a huge position down at 4,000. So even if there is some weakness here, if we move down, let's say 2% after this OPEX, that's only going to get you to in and around 4,200. And I think even if it's like a scorched earth scenario, we're only going to get down to 4,000 where you would expect to see a pretty good bounce, right? So the odds or chances of that this particular portfolio achieves positive P&L is, it seems quite challenging. And the issue is, of course, again, as time marches on, these are only going to decay and decay and decay. And just to make that final point here, if we move the portfolio to August and we do that same vol shock, what you're going to see is that you again need the market to go lower and lower and have that volatility increase to get the portfolio to pay off. So you're betting on, as time goes by, you need a worst case scenario. Your worst case scenario continues to get lower and lower and lower. So it's a very challenging position to be in from this perspective. So again, maybe this guy's long a whole bunch of equities and this is just offsetting some of that risk. We thought it was a really fascinating exercise. And again, we recommend that you look at these downside targets and these big gamma bars when things are expiring to help you set up hedges on your portfolio so that you can possibly time when volatility may uptick, for instance, around these large options expirations, and sort of what are the big support and resistance levels based on the concentration of options position. So if you want to check this out, head over to SpotGamma.com. You get a free 7-day trial. And if you have any questions on this, please put them in the comment section below.